Hey, did you catch PVR INOX's latest earnings report? It's quite a mixed bag, with some impressive highs and some concerning lows.
Oh, yeah, I glanced at the press release. Highest quarterly ticket prices and ad revenue since COVID, right? But wasn't there a PAT loss for the 9-month period?
Exactly. It's like they had a killer quarter to end the year, but the rest of the year, well, it was a bit of a struggle. I mean, let's dive into the details, shall we? Disclaimer: we advise investors to check with certified experts before taking any investment decisions. First off, PVR Inox, as you know, is the big cinema chain we all visit, and they have 1,728 screens across 111 cities in India and Sri Lanka.
Right. So their business model is pretty straightforward. They make money from tickets, food and beverages, ads, and convenience fees, and they're always expanding. Any big strategic shifts recently?
Well, they're focusing on a capital light growth model, aiming for 100 new screens that way, which means less investment upfront from their end. That sounds promising, actually. It's like when you're trying to expand your business but don't want to take on too much debt.
Makes sense. Let's get into those financial numbers. Revenue, net income, EPS. What are the key takeaways?
Okay, so for the quarter ended December 31st, 2024, they raked in 17,388 million rupees in revenue with an EBITDA of 2,583 million rupees and a PAT of 681 million rupees. This was driven by 37.3 million patrons, an ATP of 281 rupees, and SPH of 140 rupees. Now, for the 9-month period, the revenue was 45,893 million rupees, but they had a PAT loss of 460 million rupees.
So the last quarter really saved them. What about those one-time events or non-recurring items? Any unusual things impacting these figures?
The report doesn't explicitly mention any one-off events, but it does highlight that Pushpa 2 was a massive hit, contributing significantly to the quarter's box office collections. Like, huge. Also, the postponement of some major film releases did affect momentum, which is like missing a sale because the product was delayed.
Oh, before I forget, it was mentioned in the release that for Q3, the ad income booked was 1,486 million rupees, their highest post-COVID.
Oh, that is interesting. So, how does their balance sheet look? Assets, liabilities, equity, any red flags?
Well, post-merger, they've managed to reduce their net debt by 4,346 million rupees, bringing it down to 9,958 million rupees as of December 2024. I mean, that's a good sign, right? Less debt is always better, especially with those losses earlier in the year.
Definitely. So, better solvency than before, but still something to watch. What about cash flow? Are they generating enough to keep things afloat and maybe even pay dividends?
They don't mention any dividend declarations in this release, but they emphasize enhancing free cash generation. So my guess is they're prioritizing debt reduction and future growth over immediate shareholder payouts, I suppose.
Okay, no dividends this time. Let's move on to key financial ratios. Anything stand out in terms of profitability, liquidity, or debt?
From the standalone results, the debt equity ratio has decreased from 0.24 to 0.23, comparing December 2023 to December 2024. Also, their current ratio seems healthy, above 0.4. It seems like their financials are in order.
So, trending in the right direction at least. What about comparing these ratios to historical data or industry benchmarks?
From what I could gather, they're focusing on reducing fixed costs and controlling expenses, which aligns with their capital light strategy. It's like they're adapting a recipe when they're missing some key ingredients.
Okay, so they are trying to streamline. Now, about the outlook, what are they saying about the future?
They anticipate a strong rebound in Hollywood releases in 2025 and a promising Bollywood lineup. Plus, they're aiming to open 100 to 110 new screens this fiscal year, which suggests they're optimistic about growth.
Optimistic but also realistic given the earlier losses. Any potential risks or catalysts we should be aware of?
Well, rescheduling of film releases could impact earnings, as we saw in Q3. Also, competition from streaming services and changing consumer preferences always loom, right? It's like trying to predict the weather. You can only be so sure.
True, the streaming wars are real. So overall, what's your final take on PVR INOX?
Well, it looks like PVR INOX had a good last quarter, but struggled overall for the 9-month period. It seems like they are working to reduce debt and expand their footprint strategically. There were no dividends declared in the release.
Got it. So it's a bit of a turnaround story in progress. If you're listening, don't forget to like and subscribe for more deep dives into financial reports.
That's right.